the key financial highlight would certainly be the movement to positive cash EBITDA. That marks a real inflection point for Bango as we move into fiscal year 26.
Hello, you're watching Proactive. I'm joined by Bango CEO Paul Larby and CFO Matt Wilson. Paul, Matt, very good to speak with you. Paul, I'll start with you. What were the key commercial achievements in the period?
Yeah, so we just great to be here, and we just issued our trading update for the full year 25. And as a reminder, there are sort of two key elements to the Bango business. We have our digital vending machine, which basically acts as the bridge between people who have a subscription service, the likes of Netflix and Disney, and increasingly AI services and gaming services, and basically anything that does this as a subscription, and people who want to resell those services along first-party products. So think about getting sort of a streaming video service alongside your mobile phone bill, and the digital vending machine acts as the sort of the bridge between those two worlds. And that business grew really well. The recurring revenue for that business grew 30% year on year. We saw that driven by 60% increase in the number of subscriptions that the digital vending machine is managed, that now north of 24 million. Continued zero churn among those customers, and that resulted in a big increase in revenue from existing customers, plus a whole host of new customers sort of joining the platform. So really good traction in that part of the business. And the transactional business, which is largely our direct carrier billing business, in that the gross profit was up by 3%, and the core routes within that business, and there's a bit of a mix of different business types within that in the transactional business, grew by 6%. So great traction on both. But importantly, costs came down significantly, and what that resulted in is a big swing in cash EBITDA. And by cash EBITDA, I take the sort of the adjusted EBITDA less any capitalization, and that was positive for the first time, at least I can remember, and a big swing over from last year. And that increasing cash EBITDA generation is a trend we expect to continue in 26 forward. So a really good year overall.
How's customer adoption and market position evolving, Paul?
Yeah, really well. The DVM is getting more and more traction in more and more places at a faster rate than ever before. We signed 12 new DVM customers in 2025. That's compared with 9 in each of the prior 2 years. So more contracts than ever before. In the US, which has always been one of our strongest markets, we had sort of previously 6 out of the top 8 and 2 out of the top 4 telcos. Further wins in the US now means we have 3 of the top 4 and 7 of the top US telcos. So the US market now largely done, and will be a big source of growth from existing customers as all those telcos start to grow and offer more and more subscription services through the digital vending machine. And we actually saw more geographic expansion into new countries that we've never entered with a DVM before, from Japan to South Korea to Turkey to South Africa. And so really, consolidation in that US market to give us that a big footprint in what is the largest subscription market in the world, and loads of greenfield opportunity in Europe and Latin America, as well as Asia, and where we started to enter new countries. And I think that demonstrates the scale and the global relevance of the platform that's really, really important to customers.
Paul, some large contracts moved into your 2026 financial year. How should investors interpret that?
Yeah, I mean, I think you can see that quite easily on the sort of, you look at the revenue and the EBITDA figures. But I think we sort of have to take a step back and look at what is a DVM contract and what does it mean. These are very large, multi-year, multi-million-dollar contracts that are delivering some key strategic capabilities for our customers, right? They're increasingly relying on bundling as a way of differentiating their first-party services and reducing churn. And so it's a really core investment decision, and a big investment decision, because it's now, say, multi-year and multi-million-dollar sort of contracts. And then what that's led to is an extended procurement cycle in our customers, as more and more stakeholders within the customer get involved. Things just naturally take longer. And nobody finds that more frustrating than me. But I think what that does highlight is just the importance and the relevance of the DVM contracts, and how important the DVM is to our customers' core growth strategy. And the good news is the quality and the impact and the relevance of all those customers and those contracts are just the same as they were last year. They'll just close in the first part of this year, and you add on to that an increasingly strong pipeline that really we're all set for continued strong growth in the number of subscriptions we're managing, growth from existing customers, as well as growth from new customers that are joining the platform.
Matt, what were the key financial milestones this year?
Thanks, Stephen. As Paul said, a real solid year of progress. I think for me, the key financial highlight would certainly be the movement to positive cash EBITDA. that marks a real inflection point for Bango as we move into fiscal year 26. As Paul said, cash EBITDA is essentially adjusted EBITDA less CapEx. And so that gives a true measure of cash earnings in the business. And so quite rightly, a measure that we're very, very focused on. We delivered a 2.5 million increase year on year in this metric. And that's a reflection of both underlying strong recurring revenue growth, and we saw ARR up 30% on the year, as well as underlying cost efficiencies following the initiatives that we launched in the last 12 months.
The transactional revenue declined. How should investors look at that, Matt?
Sure. I think it's important to not just focus on the headline figures. So as is often the case, the real picture can sometimes be in the detail. So if you look at the performance of what we call our core transactional routes, this is the more profitable part of the portfolio and about 85% of the mix. Performance here was better than planned and up 6% on the year, which is a good success. We then have a small number of lower margin routes, and we refer to these as our higher cost of sales routes. These saw volatility in sales throughout the year, and it was expected, but that's offset the growth that we've seen in the core transactional portfolio. If you move further down and look at it on a gross profit level, because those low margin routes have very limited impact on profit, you see that the gross profit in the transactional segment increased 3% year on year. So it gives a better measure and a true indicator of performance. I think now with the Docomo Digital acquisition now fully complete and integrated, you're seeing EBITDA margins in this segment of at least 40%. And when you layer on minimal CapEx requirements, it shows that it's a strong source of cash for the business and a real success story for Bango.
And how should investors think about costs, leverage, and the balance sheet, Matt?
Yeah, good question. So I think from a cost perspective, there's been a real focus this year, and we've now got a structurally much leaner business. So we delivered a 2.9 million reduction in core administrative expenses, and that was despite 1.1 million of FX headwinds in our cost base as we saw the dollar move against the pound and the euro unfavorably last year. If you look at our other income line, that was also 1.2 million lower than last year. So if we normalize for both of those effects, then adjusted EBITDA was actually more than 20% up year on year. If we then look at net debt, so net debt came in at 9.3 million, slightly ahead of analyst expectations. And as we move further into FY26, as Paul mentioned, with greater revenue visibility and increase in cash EBITDA, we should see leverage continue to reduce.
Paul, so lots of progress. How would you summarize the outlook for Bango in full year 26?
Yeah, I mean, I think 25, as you've heard, has been a year focused on execution, not just on growth on the top line, but on optimizing and implementing cost efficiencies to get the fundamental cost base of the business at the right level that we can continue to generate more top line from. And I think we've done that in 2025, and so 2026 becomes a year of firstly getting those contracts over the line that moved out of 2025, closing the new DVM pipeline deals that are coming in faster and faster in all sorts of different verticals, loads of exciting things that we hope to be able to tell investors about as we move throughout the year. And fundamentally, we're increasingly focusing all our product effort on reducing that friction so that customers can launch more subscription services faster than ever before. And so that content providers who have the subscription services and the resellers who are reselling those services can find each other and launch those services, much more quickly. And that will generate even more subscriptions through the platform, which will generate that recurring revenue growth. So as we enter 26, laser focused on the growth of that digital vending machine business and how we get more subscriptions with fundamentally a cost base that is at the right level moving forward. Then, as we say, it's a year of not just top line growth, but of increased cash EBITDA, and that's it's a really exciting place to be.
Paul, Matt, I hope you'll continue to keep us updated with your progress. Thank you very much for your time today.